And now, The Money Show with Motheo Khoaripe
on 702. Let's walk the talk.
The Money Show with Stephen Grootes is brought to you by Absa CIB, proud to support Gensa Energy's investment in the infrastructure powering West Africa's growth. Good evening and welcome to The Money Show. My name is Motheo Khoaripe in for Stephen this week, and we're tackling a lot of interesting business stories today as well. Starting off with Transnet planning to sell or lease 15 properties it considers non-core assets, including the iconic Carlton Centre in Johannesburg, once the crown jewel of the Johannesburg CBD. They're valuing that property at around 900 million rand. If they do sell, definitely would be much needed a capital injection for the state-owned Transnet. We'll be talking about that particular transaction with Professor Jan Havenga, logistics professor at Stellenbosch University and director at Gain Group. Then we talk about the MTN results as promised yesterday, looking at the numbers of the telecoms company that is dominating around 19 markets on the continent and elsewhere around the world. MTN releasing quite positive results. Service revenue up 17.5% to 115 billion rand. We'll be talking to the group CEO, Ralph Mupita, here on The Money Show. Then some love letters being sent on the Johannesburg Stock Exchange. Northam Platinum saying they received a love letter from another platinum producer here in South Africa who are perhaps proposing a takeover. We'll be talking market commentary with Anthony Mudisane, who's the senior equity sales trader at Absa Corporate and Investment Banking. Later on the show, we look at the business stories from around the continent. That with Professor Rutendo Hidwingwi, the founding director of Tribe Africa Advisory and author of Rumble in the Jungle Reloaded. In our personal finances, this week marks 2 years since the introduction of the two-part retirement system. A lot of South Africans are jumping on that because, of course, we're in a tight economy, a lot needing cash quite quickly, some taking out the cash to maybe fix some of their financial problems, some even investing it. We'll be finding out how this particular plan has played out, the positives and the negatives with Warren Ingram, co-founder of Galileo Capital. That's much later on the show, around 1948 here on The Money Show. But for now, let's talk money.
The Money Show
On 702. Let's walk the talk.
on 92.7 or 106 FM and DSTV channel 856.
It is a little after 6 here on The Money Show. We're getting news out of 14th Avenue, the headquarters of MTN, one of the largest telecommunication providers here on this continent. Speaking to CEO Ralph Mupita about the company's latest results and what they had to offer over the operating period. Welcome to The Money Show.
Thank you very much. Much appreciated. And good evening to your listeners.
I guess let's start with the broader sense and dial into those numbers across all your 19 markets, if I'm counting correctly, and how things went over the period.
Yeah, I mean, we saw very strong commercial momentum across our markets. Nigeria, Ghana, Cote d'Ivoire, Cameroon, Uganda in particular showed very, very strong growth. In South Africa, we saw a starting off a recovery on our prepaid business, which had been a bit under pressure, but very good growth on the postpaid enterprise and wholesale side. So overall, very solid commercial momentum, which translated into strong financial results. We recorded our highest EBITDA margin, probably for the last 12 or so years. So, that growth, turning into, very good financials. The other things that we highlighted from the results were really around progress we're making around the IHS acquisition. It's $2.2 billion equity value in terms of buying out the outstanding shareholders. We've had a successful EGM there. We're getting through all the regulatory processes, and we anticipate, the transaction should close by the end of this year, subject to regulatory approvals. And then finally, we're launching our buyback. We have a 6 billion rand share buyback. We'll cancel those shares on buyback as part of our capital allocation and driving our shareholder remuneration framework.
You had strong markets come through this time around, with Nigeria and Ghana pulling the rest of the group up, if one can put it that way. What did you do there differently that made sure that those numbers came correct?
Look, I think it's a portfolio effect. You will well remember, 2 years ago, Nigeria was not as strong a shape, and that's what a portfolio does, is that sometimes when, parts of the business are not doing as well, or there's some shocks, that you have, others that are kind of doing some of the heavy lifting. So Nigeria, the painful, period of, currency devaluation, depreciation that happened in 2024 kind of is behind us. And inflation has come down. The Naira is very stable. Demand for our services remain high. We're seeing just in this quarter two, very strong net additions, new customers coming onto our network. We've got 92 million Nigerians using our network on a regular basis. So a more kind of constructive, benign, let's call it that, macro environment, supported by kind of growth in digital services demand, that drove a very strong set of financial results, strong margins, strong cash generation, and so forth. So, that business continues to be a strong anchor. It's probably about a third of the earnings of the company at the moment.
MTN South Africa, not entirely bad, but quite flat compared to the rest of the units in your portfolio. What would you point that to? Is it a tough economic time in South Africa where people are not looking to, acquire new cell phones through maybe a provider like MTN? What is it that made this particular unit more flat this time around?
Yeah, we registered 1.5 as service revenue growth from the prior period. And, it's the South African consumer is fairly resilient, to be clear. So we can't put it on the consumer as where, in terms of that there is not enough demand. Now, if you look at the different businesses within South Africa, wholesale is growing very strongly. We provide wholesale services to other parties that grew double digits. The enterprise is growing quite strongly, about 6% service revenue growth. Postpaid, the postpaid market, contract market, again, growing healthily above inflation. And prepaid data is growing well. The key issue is prepaid voice. We saw a deceleration on voice in the prepaid sector. And that's a big, bundle of revenue that has historically been there. We anticipate prepaid voice will continue to decline as people start using more messaging. So the big drag to performance is really around voice in South Africa. So it's quite specific. All the other areas are growing above inflation. The only area that's not growing above inflation is prepaid voice. Prepaid voice was down just over 10.5%. We have a reset program where we think in the next couple of quarters we should really be getting the South African business back to much healthier growth.
Then looking at, prepaid and people using airtime, especially in South Africa, when you speak to the banks, they'll tell you that, when times are tough in South Africa, consumers default on loans. Are you finding that those that do get airtime from you using airtime advances are also starting to default?
Well, actually, we're having a different experience because we took deliberate actions actually at the beginning of this year to reduce the extent of which we do this airtime advance. We've pulled that down. It's probably about half what we were doing at the peak in terms of monthly
and do you have that number?
Airtime advance. I won't say the number to you it's probably commercially sensitive, but I think you ought to think of it, we reduced it to about half into our base. The repayments rates actually have improved. If I'm talking to you, in October last year, I would have said 50% pay within 30 days. We've got 70% now. So we really focused on, building a prepaid high quality base, with the kind of appropriate reliance on airtime advance. So On the prepaid market, we had probably about 42% of our base was using airtime advance at any stage, down to very low 30s now. And I think at the low 30s levels, with repayments of 70% plus, it's pretty healthy.
We've seen in the US a lot of talk around sanctioning Iran, one of the markets that you were involved in. You have I think a 49% holding in Iran Cell still. Do you foresee maybe that sanction hitting you in terms of getting that capital, extracting it out of Iran?
Look, we've been, consistent that we want to exit the Middle East. We want to focus our efforts in Africa. And that's a strategy that we announced, more than 5 years ago, and we've exited Yemen, Afghanistan, Syria, and so forth. So the only market we haven't been able to exit is Iran because, sanctions came back in May 2018. And the sanction structure and the inability of Iran to be out of the SWIFT system, where, money flows, meant that, it's effectively a frozen asset. We can't put money in, we can't take any money out, and we're very diligent around following U.S. sanctions and ensuring that that entity complies, with U.S. sanctions and all the other sanctions, to be honest, that exist. We have a team out in Dubai that's constantly monitoring that. So our position is, there's very little we can do until there is the ability to exit. And I think the instrument that will enable us to exit is the point where, sanctions are removed, we would exit. That business is worth probably only 3% in terms of the earnings of the company, 7% of net assets. So it's actually financially quite small. We don't have any MTN secondees there. We last had MTN secondees, 3 of them, around the 14th of January. They've been out of the country. So it's effectively an investment without MTN participation at the moment.
All right, some clean set of results there for MTN, of course, saying their fintech business also up with 71 million users then in that part of the business. So that's working out for them. The mobile money as well, having some cloud backing from Ericsson. So a lot to build for MTN into the future. Thank you there to CEO Ralph Mupita for those, they're just going through some of those results and the numbers for the year.
The Money Show
With Motheo Khoaripe
on 702. Let's walk the talk.
We've been having a keen interest in South African cities with the upcoming local elections, looking at how things can be reformed, how things can be fixed, and what strategies can be used to get the cities like Johannesburg, like Durban, like Cape Town back to where they need to be so people are employed, the municipalities functioning, and those rates that we pay actually go to good use. Now we're chatting to Dr. Roy Havenga, the senior economist at the Bureau for Economic Research, also an author of How to Un-F a Country, 6 Things to Reboot South Africa. Quite frank you are, Doctor, but I'd like to get into that conversation quite direct. A lot of problems in Johannesburg. Is the reform working? Is what Treasury is trying to do in terms of being quite tough on municipalities also going to work to try and fix the cities?
Good evening. Yes, I think that there is slow but meaningful progress. One of the big things that the Treasury is trying to do is something called Metro Trading Services Reform. And that really, the idea of that is what you do is you ring fence the 2 big problems and other services, so city water and city power. And the idea there is that you make sure that those 2 entities increasingly begin to function appropriately. It also applies to waste and some of the other service functions of the city. Because what we've seen over the last number of years is that those 2 big utilities in the city have not been managed very well, and the consequence has been, as everybody knows, water disruptions and electricity disruptions.
One thing about metros then is that there are a lot of people that go to metros for opportunities, job opportunities, businesses, but sometimes they don't materialize. Then you find yourself with a very large population, but very few people paying rates. How do we then strike a balance where the opportunities match the demand for people wanting to stay there?
Yes, absolutely. And of course, the more successful a city becomes, the more people flock there, which is exactly what you want, because you want the cities to be drivers of economic growth. We put out a recent study where we highlighted that, for example, the three big metros in Gauteng make up 90% of the Gauteng economy, which is obviously a huge portion of the South African economy. But one of the issues has been actually that the metros are not able to raise revenue from their existing rate space. So Joburg's revenue collection rate has declined to 86% from 86.6%. So it's about 86% of the revenue that they're actually getting in. And that's not on new residents coming in, that's actually on the existing residents. So they need to do a lot to enhance their revenue collection capacity, getting billing to work, making sure the bills work properly. I mean, this has been something the city's been struggling with for a very long time. I think any of us that have had a bill from the city would know. And so those are things you can do.
Well, the Bureau for Economic Research, with that research note, talking about what is going on in South Africa's municipalities. Before you make that vote in November, you might want to dig into that research and look at what the real picture is across South Africa, looking at Cape Town, Durban, and Johannesburg.
The Money Show.
The markets.
Interesting things happening on the market today. Some love letters, like I said earlier on, coming through. A lot of proposals coming through as well on the market. Our market commentary with Anthony Mudisani, senior equity sales trader at Absa CIB. I want us to start with Northam saying, releasing a cautionary statement, right? Saying they received an unsolicited offer from an South African PGM producer. That's quite interesting. But what they've also done is also opened up to anyone who wants to offer them now. I think they're in the market.
Yeah, so thank you for having me. Always good to be here. So made for an interesting afternoon. Sens broke, stock went up 9% into a volatility auction. Then everyone started digesting and answer the question, who could it be? Sibanye, Impala, highly unlikely.
Volterra?
And Volterra, right? The looming one. So if we look at how things ended at the end of the day, Northams was up 3.1% and you had Volterra down 5.4%. So if we read between the lines there, I think
what are we to say? Volterra shareholders aren't happy with.
Look, you know what? From a synergies perspective, Volterra does make sense in terms of the preferred suitor. They have a couple of mines that are adjacent. I think Northams has they're sort of refining or processing gets done in Germany at the moment, whereas Northams has capacity. I beg your pardon, Volterra has capacity to take that on board themselves. I think it's at the Zonderende mine or one or two of the others there. So, if you look at it from a synergy perspective, yeah, but maybe Northams is just sort of playing with the market, trying to see who would be interested, who would be a keen suitor at this point.
Does this also affect value, given who is willing to approach as a suitor? Because, of course, once the murmurs go around, you know who's approaching and at what price.
Yeah, so I mean, look, that's sort of what we're trying to infer by the share price performance today. I think it's an interesting time. We didn't, it probably did catch the market by surprise. It wasn't something that was widely communicated. I think it will be interesting to see how things transpire. Does that force that bidder's hand to come in and say cautionary, and then it clears the air a little bit, and then you have to assign valuations to it.
A lot of action for miners. Goldfields coming through with some results today, announcing profit of $1.8 billion or 28 billion rand for the 6 months ended in June. Also some dividend payments there for shareholders.
Yeah, so the dividend was the main story. Shareholders love receiving money, right?
Of course, who doesn't?
It's the reason why you put your money there, right? So, I mean, it was a big dividend story. But so the one thing I will caution is that we're waiting on an update from Tarkwa, right? That's the mine in Ghana. There's been, a renewal of the lease. We haven't heard any communication.
Mining rights, yeah.
Exactly. So, the market is still very cautious on it, but we saw up 1.1% today. So, still happy.
The rand breaking that 15 rand mark. We've been waiting for 2 weeks now, and it finally happened today. But it happens on a day when gold and platinum are down. So what was pushing up that buoyancy for the rand? Is it just a weaker dollar?
Yeah, look, so it was breaking through 16. We can't wait for 15, right? But yeah, through 16, it sort of tested it a couple of times yesterday. I think the dollar debasement story is back intact again, just given the escalation in trade tensions. You've got trade tensions between the US and Canada. You've got Iran and the US sort of at a stalemate at this juncture. So, you've got a weaker dollar, and that's sort of what's supporting the rand at this point.
We have, I think, a growth number for South Africa next week, Tuesday. Are you seeing that maybe getting in the way of this buoyant rand?
Look, it's been tough for the consumer, but I think we've held up relatively well. If you even look at the inflation figures that have come through, inflation has seemed to be rather well contained, just given the geopolitical backdrop and the oil price spike. But yeah, I mean, it's hard to be overly bullish about next week's GDP number. I think the rand will be, beholden to the dollar at this juncture in terms of where we are.
All right, that was Anthony Modisane, senior equity sales trader at Absa CIB. Sasol down 6% today. Of course, that's because the price of oil had also gone down today by 2% at $88 a barrel. A swift but quite clear market commentary there coming through from Anthony Modisane.
The Money Show with Motheo Khoaripe
on 702.
702.
Welcome back to The Money Show, talking about a very touchy topic now for a lot of South African students who try further their education, whether using loans or using NSFAS and any form of funding they can get their hands on, only for them to not get their degrees and certificates right at the end as they're supposed to join the economic play of South Africa's economy. We're going to be talking to Professor Bonang Mohale, is the Chancellor of the University of Free State, former President of the Business Unity South Africa, BUSA, about this particular topic. Yes, the debt is high in terms of students that don't repay their student loans, but also how can we work out a way for those graduates to join the economy and not have their certificates withheld? Professor Bonang Mohale, welcome to The Money Show, a touchy subject for many of South Africa's graduates, because you do want to do your studies, you do want to do well, but when you are financially excluded by a situation, it's not something that lands well.
Morana Motheo, ke a leboha hle moholwane, especially because just because you chose poor parents should not be the reason why you are excluded from the 26 public universities that have 1.3 million students, and 1.1 million of them are already beneficiaries of NSFAS. But unfortunately, this 54 billion rands that is spent a year every year also goes to the niece and nephews of corrupt politicians to the tune of 40,000, which then means there's another 40,000 deserving students who can be funded by NSFAS, especially in Ntate Motheo, because South Africa is not a poor country, just poorly managed. Let me make you an example. Our national debt is 375 billion US dollars. This is the size of the nominal GDP of Nigeria at 377 billion. And it's bigger than the economy of Algeria at 317. But also the PIC manages 188 billion assets under management.
Yeah.
This is bigger than the GDP of Angola at 152 billion. SARS just last year, the year ended 28th of February 2026, collected 125 billion US dollars. This is bigger than the GDP of the DRC at 123 billion. Gauteng's province nominal GDP is 165 billion. If it was an African country, it will be the sixth. The same with the city of Johannesburg at 135 billion. It will be the seventh biggest African country. Its economy bigger than that of Kenya and Tanzania. Motheo.
Public universities, Mr. Bonang Mohale, would tell you that this debt has ballooned to an estimated 24 to 59 billion rand. And they need that money to also make sure the institutions keep up with infrastructure and making sure that other students who are paying are also taken care of. Is there a way we can find an equal footing? Perhaps if somebody graduates or is about to graduate, we say, okay, you can't pay back your fees right now, but when you do find a job, start paying instead of withholding the certificates.
So if we were not succumbing to greed, and if the system was not corrupted, it would be easy for you to educate these students and then keep track of them so that when they start working, you then collect, like we do with our municipality rates and taxes. They know where we live. But the problem is because we don't have effective and efficient leaders of these institutions, people who don't know much about management. But here's a bigger problem, Motheo. Rolihlahla Nelson Mandela, our first democratically elected president, said education is the surest way in which one can transcend social classes. Born poor, by the end of 13, 20 years, you are now in the middle class. Unfortunately now, I never thought I'll see it in my lifetime, where people who sit on the top of the food chain, these are doctors, clinicians, GPs, are the ones who are actually unemployed. In the Gauteng province alone, 800 of them could not be employed, even though their vacancies already exist in the Gauteng hospitals. The people who are unemployed now, when we talk about youth unemployment, are not just the people with degrees. It's actually people with PhDs. Now we are losing the narrative we used to give our children to say, go to school, get a good job, get married, and then be a responsible member of society. Motheo.
I could imagine then it would be quite frustrating for somebody who's gone through their degree, they've done the work, they've studied, they've done the practicals, and they know they've passed this particular degree, but they can't quite ascertain or attain rather their degree and certificate. We've seen a different approach from the likes of the University of Pretoria, where they've launched a Degrees Delivered campaign this year in July, aiming to raise around 50 million rand over the next 3 years to clear historical debt of around 1,500 qualifying undergraduate students. That's one approach. You sit as a chancellor in the Free State. Is there any approach that you can think of where students get at least the qualification that they can go into the job market with something in hand?
So at the University of the Free State, the new vice chancellor, who finished her first year in this 122-year-old institution, Professor Hester Katarina Klopper, has started an initiative from the Vice Chancellor's office that says we are going to raise funds for these students, and now being joined by the SRC in that university. But it is all our collective problem. The CSIR did a piece of work in 2010, and it said already 200,000 students graduated that year, but could not get their degrees or certificates because at that time, the historical debt was 16.5 billion, 9.2 billion of which is irrecoverable. Now it's approaching 30 billion to show that we have no plan. I think the country needs to come together and say, we spend 54 billion a year every year. Why is it that we are not effective and efficient? What is it that we can do to optimize? Maybe, just maybe, this also explains why the Vice Chancellor of the University of Fort Hare, which gave us 5 African presidents, is walking around not with 1 personal bodyguard, but 6, because the thieves want to get their dirty hands on this 54 billion per annum annual procurement budget. The people who are determining the contracts at these universities for toilet paper, for cleaning, for catering, it's actually some union members. It's actually some politicians. The people who are building student accommodation are connected to the politicians. And that's why they can even ask for more money. That's how brazen they are than the agreed minimum through USAF, for instance. So I think all of us need to put our heads together and think creatively about how we can put to good use 54 billion of NESA's funds a year, every year, instead of playing with it like this is monopoly money.
I agree with you. I mean, the issues are quite multi-layered, right? If you look at NASFAS and the multi-crises that they face there, but also on a policy level for government, a lot of promises have been made to South African young people that they will have free education, and somebody needs to fund that. So how do we work out not wasting money at NSFAS and also having a policy that makes sure that those that are vulnerable in our societies also have an opportunity to gain this top education?
So one of the things that we have to do, especially as the people who are involved in institutions of higher learning, is to make sure that we are really intentional about a number of things. Number one, how do we bring about this notion of an inclusive academic excellence so that the people who come from Limpopo, not only do they find these universities foreign, but at the moment, these institutions are outrightly hostile. Number two, I think we also need a social justice approach to the assessment of merit, even to how we get these students to get on board to be part of these 1.3 million students a year. Number three, I think we also need to find a contextual approach to this notion of academic freedom.
Yeah.
Fourth, for me, will be how do we make and give public ownership to these universities where the public are both beneficiaries but also co-craft and co-create the curriculum that will make these young people to be job ready. It's sad to say today in all our universities we are teaching these students for a world that no longer exists.
And I guess this conversation also continues in Tate Mohale because it's multifaceted and it affects the country's vulnerable, but not only the vulnerable, but also the young people in the country. Professor Bonang Mohale, the Chancellor of the University of the Free State and the former President of the Business Unity South Africa, talking to us about a very, very key issue. Thank you for your insights.
The Money Show with Stephen Grootes is brought to you by Absa CIB, proud to support Gensa Energy's investment in the infrastructure powering West Africa's growth.
5 minutes to 7, and we're tackling this story now. Transnet planning to sell or lease 15 properties it considers non-core assets, including iconic Carlton Centre in Johannesburg. Lots of memories for people there, once the crown jewel of the city. Other properties would include the Durban Station Precinct, the One Anchor Way in Cape Town, and the Bloemfontein Golf Course, as well as land beneath the Umlazi Mega City. We chat now to Professor Jan Havenga, logistics professor at Stellenbosch University. Sounds sad for those that have looked at the Johannesburg precinct of the Carlton Centre as one that is iconic, a landmark, if you will, driving into the city, but much needed for Transnet to try and inject that capital.
Yes, thank you for the invitation. I think there's a bittersweet irony behind this that a lot of people might not know, and that is during the legal succession of Transnet in the 80s. Two important points that one have to mention. One is the launch of Transnet as a company happened at the Carlton Centre. At that stage, the Carlton Centre or the Carlton Hotel did not belong to Transnet. It only bought it in 1999 for, if I remember correctly, just over 30 million
from Anglo.
Today's money. That's right. And in today's money, that's about 150 million. So it's not one of those properties that a company sort of inherited during company formation, but a massive launch function to launch Transnet as a business happened on the 20th of February 1990 at the Carlton Hotel. So that is the part of the bittersweet.
At 900 million rand, that's where Transnet has priced this particular asset. If they do get someone interested, there is a lot of foot traffic around that area, so somebody might use it as a mixed-use property. If somebody is interested and they buy into it, what would be the best way to use that capital injection, especially for a transforming company like Transnet?
I think there's a few aspects around that. One other thing that I wanted to mention that a lot of people don't realize with company formation, roughly in the region of 44,000 different properties was identified for Transnet. If I remember correctly at the time, people are not always aware of the absolute vast array of properties that Transnet actually owned. And there's two things to it. One is part of the treasury conditions for a lot of people talk about bailouts. Transnet has not received any bailouts. It receives guarantees from treasury, and some of the conditions around that the treasury has put is that Transnet must streamline, must get rid of non-core assets, must focus on its core business. And this is all part of that restructuring process, I think, which is important. And it's important that it happens. As I say, 44,000 properties, if you go back 37 years, to probably a little bit less now, but still a vast portfolio that actually should change around. If you ask how that money should be used, I think that what we are busy with at the moment is to some extent is in some way the unbundling of Transnet. Transnet is being restructured, and part of that restructuring process, I think, would be what happens with the property portfolio as such.
I mean, we need a lot of investment in the rail side of things to make sure the exports are there on time and in great volumes, but also on our harbors, we need to refurbish some of that particular property. And I guess this portfolio and reforming it and streamlining it to better the business would be a far better option for Transnet.
Absolutely. I think Transnet should concentrate on its core business, and I think that's what it's trying to do. A lot of work has gone into in the harbour side of Transnet. So what we've seen in recent times is great improvement as far as terminals are concerned. We've also seen some private sector capital coming into the terminal handling. We've seen new approaches as far as the Port Authority is concerned, obviously, which is another thing. The Ports Act of 2005 talks about the removal of the Ports Authority out of Transnet. As far as the railway is concerned, we see good improvements on the export lines. So the coal line and the iron ore line, there's been, but sadly, I don't think we have had yet enough money to invest in the general freight corridors. So the general freight corridors has fallen behind as far as reform is concerned, as far as rehabilitation is concerned.
And we need that capital there, most definitely. Unfortunately, run out of time there. Professor Jan Havenga, logistics professor at Stellenbosch University, talking about Transnet having let go of some of its properties, including the iconic Carlton Centre.
And now, The Money Show with Motheo Khoaripe
on 702. Let's walk the talk.
The Money Show with Stephen Grootes is brought to you by Absa CIB, proud to support Gensa Energy's investment in the infrastructure powering West Africa's growth. Looking at the markets and how they ended off the day today, just a bit of a recap for you if you didn't catch them at 5 o'clock. The JSE All Share up 116 points, but only just came in a few minutes before that market closed as banking stocks are surged 1%. Industrial shares were quite flat on the day, with our mining shares down 0.5%. Sasol down 6% as the oil price also dropped by about 3%. Today, some losses for Valterra. Murmurs around the market that they are making an approach for Northern Platinum. Canal Plus was down 4%. Implats down 1.7%. On the other end of the spectrum, Standard Bank was up 2%. Old Mutual enjoying gains of 1.7%. Another banking stock, Absa, up 1.5% today. But the Rand breaking that 16 Rand market, 15 Rand 95 against the US dollar. The big story of the market this afternoon.
The Money Show on 702.
Monday to Friday, 6 to 8 p.m.
The Green Economy feature on 702 and Cape Talk is brought to you by Volvo. Relax and test drive a Volvo plug-in hybrid today. We're talking the green economy now here on The Money Show just after 7, talking about just funding some of this green economy talk that we've had from both the corporates and South Africa. Vincentia Leitig, Executive Vice President of Power Renewables and Client Coverage at Standard Bank CIB, joining us for this conversation. Vincentia, welcome to The Money Show.
Thank you. Good evening.
It's one thing to propose all these deals, all these policies around renewable and green energy, but it's another one to fund them. You definitely do need the capital injection, and the government has been putting out some quite high, interesting numbers, around 2.2 trillion rand in terms of investment. How would this be portioned, would you think, in terms of funding? Should it be something that's half state and half private?
So definitely, I think that South Africa's energy and infrastructure requirement, it's simply too large to be funded by the fiscal or state-owned companies alone. I think investors, local pension funds, banks, development finance institutions, and international capital providers are looking for these sort of long-term infrastructure opportunities that generate stable and predictable returns. So I think the point behind this is that it's important that private capital should definitely not be viewed as replacing government. It should be viewed as partnering with government to get that right split in terms of how the funding should be split between government and private sector. Importantly, I think government provides the policy certainty, the planning and the regulation. And, private capital can provide the support and the necessary requirements from the funding and execution capacity to get a lot of this infrastructure delivered.
How do you structure such a deal? Because, if funders are looking for different sorts of deals, others will be looking for maybe chip makers, others are looking for development in the rest of Africa. So there's a lot of competing going around for the cash. So how do you dress up a green energy investment as something that is worthwhile and also would bring the returns for those investing?
So I think the way we look at financing these sorts of projects have changed dramatically. So it's no longer just, as you sort of alluded to, one single generating project, a wind farm, for instance, that needs funding. You're looking at the whole ecosystem now. So you're looking at the transmission line, the need for batteries, which is absolutely essential, the need for all of the input that goes into these projects to get them to operation. So there's different areas for different entities to be involved in. And it depends, I guess, on the risk profile that funders want to take. So to get a project to a bankable financial stage, there's different types of funding that's needed. For instance, developmental funding to get a project off the ground. I mentioned there's different parts of a project that's required. So it really is looking at, first of all, the best sources of capital that are needed for that funding, and then looking at the returns and risk and returns that those investors are prepared to take.
2.2 trillion rand is the size of a developing economy, so not chump change, right? So is it possible to break up some of this funding for different entities to be interested, or can you just gun for one entity who would give you that sizable amount?
No, I think there are various institutions and players that needed to be involved. I mean, there's, as I sort of mentioned, the commercial banks that form one stack in terms of the capital layer, in terms of investment, but there's also blended finance. And, this is sort of public concessional or development capital, which can be utilized and can be utilized very much as a value add to unlock a much larger pool of commercial funding. So, there are different players here, local pension funds, for example, even international capital providers, and then, of course, the government itself. So it's going to require participation from all levels to get to that amount of investment.
Would other funders be interested because of perhaps, let's say, things, especially in corporate settings, like, Green Points looking to be going green as a company? So you'd be interested in projects that speak to that sort of scope?
Absolutely. And I think these sorts of assets with long-term predictable cash flows are very attractive as well. But importantly, it's not just around the project itself and the green angle. I think, bankability is created before financial close. It's created from kind of the first day of project preparation, and all of sort of the right ingredients to get a project to feasibility makes these projects attractive to different investors.
Is it a matter of countries in the West looking to fund these sort of projects? Because, of course, we do know in terms of the amount of pollution produced, Africa quite low on those numbers, and the rest of the world turning green while we're trying to industrialize. So is that why we're seeing a lot of money from the West into the continent?
Yes, potentially, but I also think that there is local depth of market to fund these projects. Even if you look, for instance, at South Africa as an example, through the government's renewable and storage procurement programs, we've secured sort of over 300 billion of committed investment, and a large amount of that has been done by the local banks and the local investors and pension funds in South Africa. So it is a bit of a mix, but definitely the green angle does provide a role. I mean, if South Africa, for instance, does have more of a coal-based grid, that isn't necessarily the case in other Africa regions where hydro provides quite a bit of the generation.
Are there other markets that we are competing with? I know there is a big drive in South Africa, especially for South Africa's IRP 2025 project that's looking to get that 105 gigawatts of new generation capacity. But are there other markets, other developing nations that are looking to compete for such financing?
Absolutely, I think there is. Zambia, for instance, is a good example of a market where there is a lot of investor interest and appetite that obviously has been started by the drought in the region. And as I mentioned, some of these areas are very dependent on hydro generation. But I think the other point that's very key here is in order for investment in generation to happen in different regions, you really need the transmission to follow as well. You need transmission, you need interconnectors so that the electricity that's produced in different regions can also be exported and has a place to go to.
The fact that South Africa is still quite fossil fuels focused, would that count against us in terms of investors and funders determining which market to go to?
No, not necessarily, and very much because these projects are green. They're renewable energy projects, and a lot of the infrastructure need on transmission is really to allow evacuation of renewable energy. A lot of the time you'll find that your photovoltaic, your solar resource, your wind resource are in locations where there isn't transmission. And so that unlocking transmission investment unlocks funding or unlocks the ability to construct green power station or power projects like wind and solar as well. So I don't think that's the case.
Well, that was Vincentia Leitig, Executive Vice President, Power and Renewables Client Coverage at Standard Bank Corporate and Investment Banking. Thank you so much for your insights.
The Money Show, Africa Business Focus.
Covering all the stories that came out in terms of the economy and business on the African continent, the Africa Business Focus with Professor Rutendo Hidwingwi, founding director at Tribe Africa Advisory and the author of Rumble in the Jungle Reloaded, joining us here in studio, looking quite sharp in his new hat, here to talk about the numbers on the continent. Tanzania, let's start there. A name I haven't heard in quite a bit, Julius Nyerere, one of the key icons in Tanzania. They've opened a hydropower plant. Tell us more about that and how it will power that economy.
Good evening to you, Motheo, and your listeners. Indeed, it's named after Julius Nyerere. Obviously, his traditional name is Mwalimu, the teacher. It's a hydroelectric power plant to the size of over 2,700 megawatts. And it's a $2.9 billion investment that has been made. The key contractors, which is also a great story from an African industrialization perspective, Egypt Arab contractors called, and they've partnered up with El Swedi Electric. The capacity of electricity that it will produce will power about 50% of the Tanzanian grid. And over and above that, Motheo, Zambia and Kenya are also going to import electricity from there. So it's a great deal all around. Another exciting fact is that 95% of the contractors who built the facility are from Tanzania. So local employees, 161 engineers and technicians participated in the construction. So all around a great story just with regard to industrialization, electricity, power, and Tanzania is right in the middle of of that stream of developing electricity for the continent.
And here's a story that had my eyebrows up. The fact that Namibia is going to terminate an AI crop monitoring contract with a U.S. firm. Is this entirely bad news, or the fact that the contract has just come to an end?
It's a combination of the bad, the good, and the ugly. On one side, I mean, agriculture, we know from an African perspective, we own 60% of the world's most arable land, but our productivity is quite low. So anything to increase productivity is a good story. But having said that, this contract with an American company called, I think it's called Group 6 or Grain, the Sixth Grain Corporation, whereby they were going to use AI and satellite imaging and technology to monitor the country's productivity of key crops like maize. I think there was mahunga there as well. I've never eaten it, but it's there in Namibia. And where the whole deal fell down was because they wanted access to certain data, and also there was a question around the procurement process. There was a question around data sovereignty, which is all correct from a Namibian government perspective.
Yeah, you need that sovereignty, man.
Yeah, that sovereignty. And then also giving access to a private entity from a national food security. And having said that, the actual funding, Motheo, was going to be donor related. So the question though is that, why did the deal go down so far to the point where all these things came up towards the end of the deal? I think on both sides it's legitimate from a Namibia perspective, Motheo. You want to have that accountability for your sovereignty, but at the same time, you need the technology. So that balance is a fair point on both sides.
Well, I think they should reissue that particular contract and maybe have a few other bidders and start over. It's not a bad idea to map out where you can make the most of your arable land. Then looking at a Brazilian state oil giant, looking at that Keita Basin in Ghana, a lot of interest there. The state oil company in Brazil, Petrobras, I think it is.
Yeah, so Ghana has been having a problem in terms of it's got oil. I mean, I think it goes back to 2010. They discovered oil and there was a lot of investment in oil, but because obviously they don't have the investment infrastructure wealth in terms of scaling, they have dropped down to about 37.5 million barrels in 2025. They used to produce, I think they fell from about 1.5 billion to $773 million in terms of revenue from petroleum, Motheo. So they've reached out to Brazil. There are 4 blocks that Brazil is interested in terms of partnering up with Ghana. The good story or the good side of the story, Motheo, is that they're not going to own these barrels or these blocks that produce the crude oil, but they're going to partner. Petrobras is obviously from Brazil. They've done partnerships in Namibia, Sao Tome, Principe, Cote d'Ivoire, and South Africa. So it's not the first time. The way the deal is looking, it's going to be a win-win for Petrobras in terms of going to a new market with Ghana, and for Ghana, obviously stimulating productivity in terms of that oil sector that they've got the rights to.
And also, it's a good time for Ghana to get that oil intact, especially with what's happening with the US and Iran on the Strait of Hormuz. Then cotton powering Africa's industrialization. Can you explain that for us?
No, it just talks to, again, the opportunity that is there with regards to cotton. We know that cotton was a key influencer with regards to the USA, Britain, and Asia's historical economic growth. At the moment, 10% of the world's cotton comes from Africa, but only 70% is exported. 70% of it is exported as raw materials. So there's a huge gap with regards to the value chain. There's a big West African initiative in terms of looking into investing $5 billion to increase that to 25% productivity from Africa, create about 500,000 jobs, and increase $6 billion in value add in textiles. So a simple solution for a big problem in Africa, and hopefully that pans out.
All right, so that was Professor Hidingwi there talking to us about the stories on the continent, business and otherwise. Professor Rutendo Hidingwi, founding director at Tribe Africa Advisory and the author of Rumble in the Jungle Reloaded. One thing to mention, an honorable mention, of course, Angelique Kidjo getting that Hollywood Walk star.
Good stuff.
About time, really. About time. And that's how we wrap up this particular session of Africa Business
Benin,
Focus.
all the way from Benin.
The Money Show.
Personal Finance with Warren Ingram.
Chatting personal finance with Warren Ingram. This week almost marks 2 years of the two-pot retirement system. There was a big worry that with the introduction of the system, South Africans would raid their savings pots for holidays, things they would like to get once and not so much needs, and really take away from their pensions. But we're going to be talking about the positives and some of the negatives that have come with the system. Warren Ingram, co-founder of Galileo Capital, welcome again to the Money Show.
Thank you so much. Good to be on the show.
I think let's start here, Warren, in terms of this two-pot retirement system. It's been 2 years. Some of the trends that you've picked up, you worried about?
I think the big one that bothers me a lot is the people that drew in the first year are continuing. So one of the hopes was that if the government decides to divide up our retirement funds into money that's locked away for the very long term, and then another portion which is accessible, on a yearly basis, that people who are in financial trouble would use the savings pot, which is what they call the short-term money, that they would use that for kind of an emergency, and by definition, emergencies don't happen every year. They happen infrequently. And what we're seeing from the stats that are being published by retirement fund administrators is that about 2/3 of the people that withdrew in the first year have drawn again in the second year and are about to go into their third year. So what we're seeing is that actually very few people are new withdrawers. Only about 5% of the withdrawers are new. So the kind of the same group are withdrawing again and again. And maybe the second thing is the average. What are they drawing? What's the amount? And the amount isn't very large. It's kind of around that 9,000 to 10,000 rand level. And for some people, getting access to 9,000 rand in a year would be, a real emergency that's been resolved by getting that money. But I think if you're accessing it every year, it seems when members have been surveyed that they're using it to settle personal loans, overdrafts, credit cards, and some consumption stuff. In other words, just spending money. Very, very little of that money is being used to, for example, pay off a home loan or buy an asset that will generate income. It's being consumed. So it's not helping to build long-term growth. It's being used to solve a short-term problem.
Let's go back to the initial idea of why this was introduced, and perhaps a good idea in a country that doesn't have a great savings culture.
I was so happy when they implemented this. I think so. Just to understand the damage that was being done, when you've got a company retirement fund, in almost all instances nowadays, company retirement funds are called provident funds, and if you quit your job, you can, before this system was changed, you could actually access your provident fund, pay a huge amount of tax on it, but you could access the money in there. And so people who were in financial difficulty would often quit their jobs because they knew they had money in their retirement funds. They would then, cash in their retirement fund after they've quit their job, and usually pay away about 1/3 of that in tax. So you cash in, you get 100,000 rand in your retirement fund, you pay away 33,000 rand, then you've got 66,000 left to settle the problem that you had, whatever that problem was. The thing that compounded this was that people were not always able, we're in a country with very high unemployment, so people weren't always able to then get another job. So now what happens is they've quit the one thing that was kind of keeping them afloat to access money in the short term, and then settling, a debt issue, but then, actually having a much bigger debt issue, almost the very next month, because suddenly there's no income coming in.
Yeah.
And so this two-pot system, the thing that was really useful there was that it allowed people who did have a big financial emergency to have some access to retirement funds, but also forcing a portion of the money to be invested for the long term for their retirement. And so, the problem with retirement savings is it's kind of asking people to do what's good for their future selves. And unfortunately, across the world, we don't always do what's good for us. That's why people smoke and drink too much and, eat the wrong foods and all those things. So somewhere along the line, sometimes we've got to create rules. And sometimes those rules are to protect us from ourselves. And this is one of those instances where government said, well, hang on, we need to help you look after yourself when you get to retirement. So some of your money is going to be locked away, but in exchange, you can access some of your money every single year. And so a brilliant, initiative. It was meant to have been done a very long time ago. I think the unions were objecting tremendously. Maybe the one thing, if I get on my soapbox for a second, is what didn't come, which was supposed to be in the legislation, I think, was also that all employees would be forced to become members of retirement funds with this reform. Because at the moment, it's not law that if you work for an employer that you must contribute money to a retirement fund. And I think that would have been the kind of the next step to really make sure we start to look after ourselves into the future.
Which was much needed in a country that didn't have a lot of savers. But looking at those numbers and what people claimed they would do with the money, a lot of claimants before the system was introduced said they needed the money for paying debts and things like that. But it seems like South Africa's high cost of living also coming into play, with many of the claimants now spending the money on basic needs.
I think that's true. So the very sad part here is that, that money that you take out of your savings pot, if you're doing that every year, it's not tax-free or pain-free money. So what happens is, when you draw from that, I'm just going to, kind of use a very simple example. If you draw 10,000 Rand from your retirement fund, what actually happens is that SARS says, well, what are you earning in the whole year? So if you're earning, 400,000 Rand and you're paying, a tax rate of 31% on your earnings for that year, and then you draw 10,000 Rand from your savings, that 10,000 Rand gets added to your taxable salary for the year. So you pay away 31% of your 10,000 in tax. And so actually, you're getting out just under 7,000 Rand. So already you've lost there. That's money you just never get back. And then what happens after that is you lose the growth on that money for life. So if you have 10,000 Rand invested, over time, that will probably at a reasonable rate, will probably grow, over a 25-year career would be worth about 70,000 Rand in today's money. So the 10,000 you take out of your retirement fund and you've got 25 years to retirement, you could value that at 70,000 Rand. Now imagine people do that 3 years in a row.
Sure.
That means they've lost 210,000 Rand in today's money, of their own retirement capital that would look after them when they get older.
And many South Africans will tell you they need that money. Another thing, though, when it comes to SARS is that if you do owe SARS money and you withdraw perhaps 9,000 Rand and you owe SARS 11,000 Rand, they're definitely going to swallow that money before it gets to you.
Yeah, and just to explain that again, so use that, I can't do good math, so let's keep the 10,000 as an example. So let's say you owe 11,000 Rand and you draw 10,000 out of your retirement fund. What happens now is you lose 31%, so you lose the 3,100 to normal tax. And then SARS says, oh, by the way, the tax that you owed us before of 11,000, you still owe us, so we're taking the 7 to pay off some of the tax debt that you owe. So then you've got a smaller tax debt is the result, but you incurred a new tax as well. So it's just a double whammy. And for a lot of people in that first year, when we were allowed to access our savings pots, that happened. People that entire amount just got swallowed up by tax debt.
And then looking at, the preservation rates when it comes to these sort of funds, they've definitely gone up. This is word from Old Mutual that went through about 35,000 claimants, saying the preservation rates have now risen by 33%, whereas cash withdrawals on exit fell from 61% to about 50%. So we're getting somewhere.
Yeah. So, and that's, So that's the thing is, in the very short term, there is going to be pain to the whole system, because, people are, maybe some people who would not have quit a job to access their retirement funds are now accessing some of their retirement fund. But what we are finding now is that when you change jobs, you're not going to be able to cash in your new money that you've been adding since September 24, and that's just going to accumulate and grow. So no matter what people want to do, even if they wanted to access that money before retirement, they can't. And so I understand the comment around but people would love to be able to access that money now because they've got a debt issue now, and fair point. But what we are guaranteeing, as a country now, is that a huge proportion of South Africans will get to the age of 55 or 60 or 65 with a decent retirement fund now. And every year that goes past, that savings pot will grow, that retirement fund pot will grow, which means more money to be invested in the JSE, more money goes into private companies that will create jobs and grow the economy. So I'm hoping that we actually start a virtuous circle with this big shift.
I think the number is 43 billion, or just over 43 billion, has been withdrawn from retirement fund savings in South Africa since the implementation of the two-pot retirement system in September of 2024. This includes nearly 4 million withdrawals. So the withdrawals are happening. People have paid debt when they needed to. They've gone back to withdraw for a second time to pay for things they need around the house. They've gone back for a third time, perhaps to cover other living expenses. But should we not be encouraging to say, look, if you want to withdraw 10,000 Rand, perhaps consider also adding 3,500 Rand to a tax-free savings account for that particular tax year?
I always, you're kind of asking the personal trainer.
Can't tell people what to do, but certainly could encourage.
No, agreed. But I'm saying it's like asking your personal trainer, should I go to gym in the morning when I don't feel like it? The personal trainer will say, of course you should. So of course we should add to our savings. The thing I don't like about that idea though is you're drawing money out of a retirement fund, you're paying away 30% or whatever your tax rate is, 25 or 30% in tax, and then hoping that, somewhere along the line there'll be a gap to be able to then top up savings into the future. What I would much prefer is that, if you get the flexibility to be able to add to savings, maybe build up an emergency fund first. So go and create a money market account that's not in a retirement fund, it's not in a tax-free savings account. Put aside some money, so that you get to the point where maybe you get to 3 months worth of your expenses in your money market fund. And when the next emergency happens, you don't go and draw from your tax-free. Please don't do that. And you don't go and draw from your retirement fund. What you do is you go and draw it from your emergency fund. And so, that would be the kind of big long-term strategy that I think people should follow to try and protect themselves from future emergencies. But if you're in it today, what I wouldn't do is draw money out of my retirement fund and then say, well, a portion of that money I'm going to add to another savings account, because you've paid away so much tax that you're just setting yourself back 2 steps to then take 1 step forward. Rather only take half a step back if you have to.
57 billion was the payout for 2025. We've now come to almost the second year since the introduction of the two-pot retirement system in 2024. We're looking at the positives and perhaps some of the negatives that have come with the introduction of the system. One thing for sure, though, it's forcing a lot of South Africans to save their money. We'll continue this conversation after this.
The Money Show with Stephen Grootes is brought to you by Absa CIB, proud to support Gensa Energy's investment in the infrastructure powering West Africa's growth.
The Money Show.
Personal Finance with Warren Ingram.
And if you've just joined us, we're talking the two-pot retirement system. This week marks 2 years since the system was introduced in September of 2024. The now outgoing SARS Commissioner Edward Kieswetter, of course, he's left that particular seat, saying last year that a total amount of tax collected around 15 billion Rand for every withdrawal made. I think 4 million were made last year. But Warren, looking at the two-pot withdrawal system, some people have not withdrawn, and what would be the benefit of doing that in terms of sitting on your hands and just watching the money grow?
I mean, I think it's the thing that becomes kind of the holy grail of investing is, how long can you let your money grow? And there was a bank that had an ad that said, let your money make money babies, and that's what you want here. You want your money to grow on itself so that while you're sleeping, your money is growing. And retirement funds, the reason that retirement funds are so powerful in this instance is because all of the growth in a retirement fund is tax-free. So, if you've got 100,000 Rand or in your retirement fund, or, 10 million Rand, all of the interest that it earns inside that fund, and all of the dividends, all of the capital growth, it grows without paying a cent of tax. And the longer you can defer tax on your growth investments, the more you benefit. So you only pay tax on your retirement funds when you draw money out. And that's really powerful, because, something like a tax-free savings account, which is amazing, really like them, we're limited to putting in 46,000 Rand a year.
Yeah.
But with retirement funds, we can put in a lot more. So it's a way for people to kind of do real wealth creation, where you can actually build up enough money to look after yourself over your lifetime, and potentially look after your kids, or give them a good start, to their adulthood as well. So you can build intergenerational wealth just with a retirement fund. I mean, it's an incredibly powerful thing.
I mean, if you've been disciplined enough to sit on your hands and not try and withdraw, I guess there would be no sense in doing it in the second year of the system, unless you absolutely need the money. But I guess the withdrawal system also still beats the high interest loans that we're seeing in the market. It's far better to borrow from yourself, if one could put it that way, than to go to someone who will charge 22% and north of that in terms of interest payments.
Yeah, that's maybe the keys. So someone, if someone said to me, like, is there ever a good time? I think it's worth thinking about very carefully. But when you're paying 22% or 25% interest that's compounding against you, when something's compounding against you at 25% a year, it's doubling every 3 years. So if you owe 100,000 Rand on your credit card and you can't pay it off, in 3 years' time, it's 200,000. In that instance, I could understand that someone says, okay, I'm going to settle my card with my savings pot from my retirement funds, but I'm not going into that trouble again. I'm doing it to settle, and that's it. I'm never doing it again. Then for that, I think that's, for me, an emergency. But if you find yourself drawing money from your savings pot every year, and sometimes it's because I just need that holiday, I need whatever it is, the new phone, but you've got a perfectly good phone, then that's not a good reason to draw from your savings pot. It needs to be for real deep emergency.
Sanlam's latest benchmark study showing the awareness of the two-pot system has grown sharply. People are more aware of the system, from 59% in 2024 to 92% last year. Is it a system you think should last longer, and just how long should it be, at play for South Africans to catch up on their savings?
I think it's a brilliant initiative. So I hope it lasts far beyond my and your lifetime, and maybe future generations thereafter. I think it's a really good system. We should definitely not replace it. And it might not be popular in the short term, but as that whole retirement fund kind of pool of money grows, there will be a lot more money available in South Africa for investing everywhere. And maybe just the one comment there, and I mentioned at the early part of the show, is I just really think that government should look at forcing all employees to be parts of retirement funds, because that's the one thing so there's smaller companies, for example, where it's not obligatory to be part of a retirement fund, and then people opt out, and that's not good either.
We also have our listener question, a very interesting one this evening from Lindy. Says, hi, I'm 34 and my washing machine has just packed up, so I need to replace it, and probably my fridge soon too. I have been offered an account with the shop to buy these things and pay a small monthly amount, and they also mentioned a 24-month plan. My mother says this is the wrong thing to do and that I should save up and pay cash, but that could take me months, Lindy says, and I need a washing machine now. So what to do, Warren Ingram?
I think it's, it's like when you get married, Motheo, you should always listen to your wife. And Lindy, you should probably listen to your mom.
Mom knows
she knows
best.
what she's talking about. Mom knows best. So what happens is when the store gives you a payment plan, it's not like it's, if the washing machine's 10,000 Rand, it's not like you just get 10,000 Rands worth of washing machine that you afford to pay off over 24 months. You're paying off interest on that. And it's usually very, very high, very expensive interest. So suddenly, you've actually ended up paying, instead of paying 10 grand, you've paid 14 or 15 grand when you add the finance fees and the interest, etc. So I agree with your mom 100%. I would be, building up the cash and, kind of abuse the friends and family for a while to use their washing machines if you need to. I understand we all need to, get our clothes done. But I do think your mom's right. You want to build up cash to pay for appliances because there's no value to those appliances if you had to sell them, and you certainly don't want to be paying high rates of interest on something like that.
I was about to say I wouldn't imagine Lindy wants to hand wash her clothes, and I don't know, with the fridge also set to go, where would she put her stuff? I think for her, she's expressing an immediate need, while the mom is saying, stop with the instant gratification and getting the latest appliances. Put the money away. Suffer a little bit so you can have a bit of your money back to yourself.
Exactly. And you and I have to rely on Lindy's mom, right? She probably knows her daughter rather well. So I do think that's good. It's good. It's really good advice, common sense advice. If the fridge hasn't packed up, then delay as long as you can, save as fast as you can, and then, try and buy the fridge and, maybe get a second-hand one. And the same thing with a washing machine. Can you find one, it's in good quality, that's second-hand, much cheaper than buying a new one if you need to.
Brilliant insights there from Warren Ingram, co-founder of Galileo Capital. And that's how we close it here with the personal finance feature on the Tuesday edition of The Money Show. Stay in the black.
The Money Show with Stephen Grootes is brought to you by Absa CIB, proud to support Gensa Energy's investment in the infrastructure powering West Africa's growth.